Welcome back to another episode of the B2B Founder Podcast. I'm your host, Brett Trainer. Today, I'm thrilled to welcome Q Motiwala to the show. In addition to having one of the coolest names that we've had on the podcast, Q is the Managing Director at DNX Ventures. DNX is an early-stage venture capital firm based in Silicon Valley and in Tokyo that invests exclusively in B2B companies. They recently closed a $315 million fund during the pandemic. In this episode, we cover two main themes. First, the opportunity for startups in the B2B space. How else do you make that big of a bet and get the limited partners to invest, again, during a global pandemic? It was obviously in motion prior, but still impresses and signals the opportunity. Second, I get Q's perspective on what they were looking for in their startups and in their founders. He also had an interesting thought on how they have to get to know the founders virtually and why there has been some benefit to this. There is consistency from what we heard with Tim McLoughlin, general partner of Co-Founder Capital, back in episode 68, but there are also some differences as well. I think you'll enjoy this podcast. As a favor, if you enjoy this podcast, please subscribe with your platform of choice. I would greatly appreciate it. Now, on to the interview. Hey, good morning, Q. Welcome to the program.
Good morning, Brett. Thanks for having me.
It's great to have you. I've definitely been looking forward to recording this episode. As the audience knows, we talk B2B and almost exclusively B2B, unless there's some cutover. And, with what you and the firm have done, which I'm not going to spoil that, I think this is going to be a value-packed episode. So welcome. And to get us started, why don't you tell the audience a little bit about you and what you're working on today?
Thank you. Yes. So, I go by Q, and many people go, whether it's a Star Trek Q or the James Bond. I prefer the James Bond one. But the reason for the name is because I spent about 11 years straight when I came out of school at Qualcomm. And I'm basically an operator by nature. And so I did engineering, leading chipsets and, mobile phone, base station designs, etc. And then half of that time at Qualcomm was spent as product management, business development, deploying some of these new technologies. At that time, it was 3G into places like Japan, South Korea, Verizon, and a couple of other places, and also some technologies into at that time OnStar and compact laptops before there was IoT. So that was essentially the background I came out of it. And in the last couple of years at Qualcomm, I was also finishing up my business school. And there was this fire that was there. When I joined Qualcomm, I had real fun because it was a small startup really in the early 90s. Right. And I wanted to recreate that magic once more. So I went off to startup land and I was part of two startups. I was not the founder, but I always either was doing product management or head of marketing kind of roles. And it was through those two startups that I fell onto the dark side, which is venture capital. So I'm really an operator in the guise of a VC. But that's the brief story. And so it was 2007, 2008, around that time frame, when some of the folks who had invested in my startup and I got really close together in terms of we thought the same way, same wavelength on what we want to do for entrepreneurs, et cetera. And so we ended up joining hands and said, well, let's start a new fund. I mean, how ignorant were we? Because that's the day that Lehman crashed. And, you were looking at each other and saying, oh boy, what do we do here? I think great firms are created during those kind of moments, the moments of crisis. That was the global financial crisis at that time. Instead of going and getting, other jobs, we kind of hung in. And it took us about 3 years before we could get a measly, humble $20 million together. And we started investing, but we had the core focus of B2B. And I think, along the journey, we met some great entrepreneurs who delivered some, awesome returns. And on the backs of those fantastic people, we were then able to, raise several funds. And our latest fund is now, $315 million. The team grew from 3 people to 20 people, and we now have much better platform and support for our portfolio company CEOs that we didn't have back then. But that's a brief background of my personal background. DNX Ventures itself is an early stage B2B focused fund. We invest in two geographies, US and Japan, and we'll get to the reasons why specifically those two. In US, we do a lot of I would say cybersecurity, enterprise software, and cloud infrastructure. We do a lot of deep tech investments, and then we have practices for also fintech and retail tech. In Japan, we primarily focus on enterprise SaaS. A lot of SaaS enablement that happens, on top of cloud services, but this might be things like marketing automation, sales automation, or digitization of traditional industries like construction and healthcare and things like that. But we'll go into all of that stuff deeper. But I just wanted to give you a broad brush of what DNX is.
Yeah, and I don't know if it was timing, luck, or you make your own luck, but and you kind of understated the $315 million dollar fund exclusively focused on early stage B2B is huge. Obviously, we've seen different investments going after SaaS because it's sexy, but I mean the fact is you guys chose to head down, and I've been on the pillar for a couple of years that transformation needs to happen in the B2B space. So and maybe it was because you grew up in the B2B space, you guys decided to focus that first fund, but maybe you can go into a little bit on, I mean, 315 is a really large fund for early stage B2B, especially you closed it during the pandemic or finalized. Most of the fundraising was probably done before. So maybe you could touch on a little bit of the why and then the how during the timing.
Yeah, no, we started raising before the pandemic, but what we saw is two things happen. One is acceleration, and second is we had set ourselves a target for 250 to 75, and we overshot it. And I think there are several reasons for this. One is the pandemic has shown that everybody is now going to be working from their home offices, Starbucks, all of that stuff. So essentially the requirements for whether it's software, whether it's other things that are going to be distributed, cloud security, all of that stuff is going to be super important. Essentially what happened was somebody took the enterprise, blew it up, and made it a distributed the home is now the distributed enterprise. So now what does that mean for everything that's underlying below, from cybersecurity all the way to cloud tools, DevOps, all of that stuff. So that was one big factor I think that we saw. Number two is our performance, especially on the Japan side, was just phenomenal. I mean, we had returns to back from that. Japan is going through like a obviously a massive kind of resurgence from the deflationary period in the last decade. Macroeconomics wise, Japan has been fantastic, but at the same time, you've also got the startup ecosystem really bloom. So I'll just list a couple of reasons. So that was the second reason of having a very good financial track record. Number three, I would say, is laser focused on B2B. We are not, we understand that we are not the best consumer focused VC, and we don't understand marketing brands. So I think that laser focused on both B2B and the sectors within the B2B, I think worked in our favor as well. So that was some of the reasons that this thing accelerated. I think if we were on our first fund, that this was the first fund, I think it would be the same thing what I told you in 2008. It would have taken us a couple of years.
Right.
Hey, do you guys? This is just a PowerPoint. Where is the track record of, or where is actually the team that's going to do this? So I think several of the factors came together.
Yeah, and it makes sense. And like I said, I've been kind of on the mountaintop for the last couple of years, especially when I was in management consulting, that the digital transformation is coming. The buyers are going to force change. Either you're going to do it or a competitor's coming up, your competition is going to figure it out. So I'm curious too, from your perspective on, from technology, since you're investing mostly in technology, to the adoption of technology within B2B firms. So if you look at the technology curve, it's accelerating with cool new tools, and you just like sales tech stacks and Marcom and all that. but most of these B2B companies aren't using them yet. So how do you, again, this is just down that rabbit hole we kind of talked about. I'm just curious from your perspective, how do you see the adoption rising from these B2B firms, or is it just betting on maybe earlier, younger companies adopting quicker than maybe some of the old legacy B2B firms?
Right. I think you've got to combine the B2B with the DX, which is the digitization thing that's going on. And if I understand the question right, I think the underlying trend, in addition to all the things that we talked about, people moving to cloud and all that stuff, is also these old traditional industries that are actually moving towards digitization. I think that has to do a lot with things like you might not have enough skilled workers, or you want to reduce costs. Or, for example, moving to DX is actually going to give you a much better lens into customer needs or customer enablement and things like that. So, I'll give you a few examples. We've seen this trend in construction, for example, in Japan, or for example, in things like pharmacies, how people, when they actually go in and say, hey, I want this medication. Well, they've got to ask you 8 or 10 different questions on how you want to do that. Well, digitize that entire process and make sure that you're not going to have allergic reactions, to something. So taking constructions, pharmacy, fleet management, we've just seen across the board everything that management consultants like yourself or McKinsey or used to preach, hey, you could have to digitize. Well, it's no longer Fortune 100 digitizing. It's essentially the entire SMB segment as well now saying, hey, I'm going to digitize because the cost is a monthly fee, a monthly SaaS fee. It's not millions of dollars of Oracle products that I've got to put in and then bring consultants in to implement it. It's a much lower cost to digitize. I don't know if I went down the different rabbit hole than the rabbit hole you were trying to go into, but I'm happy to pull myself back out.
No, that was good. I mean, I think that exactly, the world is digitizing. And, one of the things, growing up and living in the enterprise world for the long time in the different operating units, right? So between sales, everybody talks about the misalignment between sales and marketing, but I think if you've got operating budgets, these larger companies between sales, marketing, maybe demand generation, customer success, product, all have misaligned goals. And so all of a sudden now you've got to come in and say, all right, we're going to digitize the business. It's really hard. And I don't want to minimize how hard that is. And that's kind of some of the stuff I've been preaching and writing about is, this is an opportunity for startups to come in and say, look at some of these that are really slow at migrating. And you have an opportunity because unless the C-level or the board of directors makes this a top priority, you may get one or two groups, but that's not going to solve the problem. So no, I think that's where you get right.
Right. And so I think your question has 2 parts. One is the companies that are being born post-pandemic. And then there are companies that already existed pre-pandemic. And so we've seen changes on both sides. The things that you talked about, like sales enablement and marketing, whether it's attribution or building things like marketing cloud on top of a CRM like a Salesforce, all of those things were happening. But I think for those companies, what ended up happening for us is that the founders and the management teams adapted really well to how to sell to the B2B space. I think we'll talk about that, where those companies did not anticipate a pandemic, but reacted really well on changing, whether it was indirect selling or whether it's using webinars, or in the case of Japan, you don't even need to, Japan has done an awesome job. Only 1,000 deaths so far compared to our 225 and rising, 225,000 and rising. So Japan has not been as affected in terms of the founders and the B2B sales folks. But so it's the pre-pandemic companies, and then you've got the companies that were born at this time. Well, the companies born at this time bring in a different DNA. You're going after remote work from day one. You don't need to have all engineers based in the Valley, right? You could essentially, figure out all around the US, wherever is the best engineer, or, hopefully similar time zones, because it gets difficult sometimes. But so those two also an interesting subject for us to speak about.
Yeah, I think that'd almost be another whole podcast episode we could go on to. But that's kind of where I want the audience to think about this, is those opportunities, and how you go to market is different than maybe what you've done traditionally. Because I do find a lot of the B2B entrepreneurs or founders tend to come from the corporate side first. Either they couldn't get a problem solved and they're starting to solve it themselves. And so they kind of grew up with, I need to hire a salesperson, I need to do marketing. But the fact that everybody has now been remote, you're not getting that, as they say, the cat back in the bag or the rabbit back in the hat, because people have figured out if there's a better way to work, and we'll find there's going to be a happy medium at some point. So I think that's maybe a good transition, because I definitely want to get into, with the size of the fund, you're now on fund 3, to get your perspective on what have been, some of the companies you've invested in. What are you looking for in those entrepreneurs? And as they're starting to build their businesses, what should they be thinking about? What have you found that's, made success? Is it just the ideas, the people, some combination of the two? I'd love to hear it from your perspective.
Absolutely. So we'll talk about both the regions, US and Japan, what we're investing in for Fund 3. And in Japan, the focus is more on digitization of the traditional enterprises, and a lot of, I would say, things that are above the cloud enablement layer on the SaaS platforms, whether it's marketing, sales automation, that continues to be a good focus. But digitization of traditional industries is working out really good. In the US, we are, this whole trend of remote work has been very good in terms of us thinking in terms of edge computing, in terms of cloud cybersecurity, zero trust type of things, and also some automation. Like we just invested, for example, in a company in Austin which is building robots for hospitals so that we can essentially get nurse efficiency. There's a shortage of nurses during COVID, and it's always been there, but COVID actually even amplifies that more. So those are some of the big kind of trends that we have been investing in. In terms of, I would say, stage, we tend to be, our new fund is very much a C plus and Series A category.
Okay.
We'll invest anywhere from $1 million to $4 million, depending on whether you've got some revenue, whether you've got your product built. So 1 to 4 to start with, and then we'll follow it up, up to a maximum of say $10 million during the life of the company. So C plus and A tends to be our good sweet spots.
And it tends to be a gap too, right? And at least in my limited time looking at it, right? That especially in the B2B space, what I've heard from, from the seed to the Series A is a pretty good delta in a lot of cases. And
Correct.
You may get a good idea that's got some revenue. You may be able to sell into your network and build, some good success cases, but maybe at $1 million, $1.5 million in revenue. And a lot of the Series A are looking at 5 to 10 million. All of a sudden, you got probably a really good company that's maybe having trouble expanding, that gets kind of caught in the no man's land, if you will. So it looks like you guys are kind of focused on that area. That we found a good idea. I'm assuming you've got some criteria for the entrepreneurs. Or are you more focused on the idea when you're looking to invest?
Right. Our sweet spot, as I said, is C plus and A. What that means is these are entrepreneurs that are somewhere between 0 to 5 million ARR. Okay. Above 5 million ARR, I think there are way better VCs here in the Valley who can help you blast and get you to 50. I think, we actually would do really well helping entrepreneurs getting from that, initial to $5 million. So what that essentially means is, what is going to be the focus tends to be, then this is a founder-led sales, okay,
Yeah.
in these initial stages, which means most likely the founder is a technologist or heavily technical person coming out from some of these larger corporates, whether it might be a Google or whatever, or it might be someone who's actually done a previous startup and they're coming out and doing it. But I think at that particular stage, at 0 to 5 stage, you pretty much are looking at the DNA of the management team. That's really, you obviously there are 8 to 10 different things, like what market are they going after? Is it really a pain true pain that they're solving, sizing, and then how will they grow into another market, all of that stuff. Absolutely. I mean, I think anybody you have on the podcast will basically go and write down those 8 things of what we need to see. But I think at this stage, it's really important. So we can go down the rabbit hole of what that management founding team makeup, is really important. None of the companies will have exactly the same. Company A is going to have a different founding team. B is going to have. So what we try to look for, I think that is a really important angle.
Yeah, no, and I'd love if you'd share, if it's not protected, just to get an idea of what you guys are looking for. Because I know certain industry, market size, all that good stuff, check the boxes, but maybe some of the intangibles that you're looking at, maybe, like I said, maybe it differs by team, but is there maybe certain key characteristics or criteria that you're looking for? Or is it just based on, hey, I've done this so many times, I've got an intuition about which of these teams are going to perform?
First of all, I don't like this idea of pattern matching that people talk and pattern recognition, because I think there's a little bit of a falsehood there that every entrepreneur has to fit in this mold. Oh, I've seen this before, and this is what's going to happen.
Right.
My firm belief is every entrepreneur, every company is a snowflake. Totally different. So what we have started doing in the last 6 months that we had not done before, and this is something that the pandemic really helped us think through, is we bring in the founder for a socially distant lunch in our backyard, and then we go off for a walk, and then it becomes like a 9 a.m. to 12 noon journey. And this is what used to be in the older times, 9 a.m. to 9:45, and then someone would knock at your door and say the next meeting is going to start, right? But now what you have is this entire good 3 hours to get to know the makeup of the founder. How does this person, what makes this person tick? Why did they really start this particular adventure? Are they going to just go and sell off if they get a 25 or a $50 million offer? Because some of these companies, a Google or a Microsoft or someone is just going to say, hey, I'll just buy it. Why let it grow? So we try to understand what makes them tick. We try to understand what is their hiring philosophy. Are they going to hire people just friends of X, the founder being X, or are they looking for more diversified workforce, both in terms of diversity, in terms of industries, in terms of gender, in terms of location? We just look for people who think that way, and then what we look for is what are the kind of sales and channel people that they're going to get in, and what is the strategy out there? Because you might find certain founders will go towards name brands. So I'll hire the sales guy from Google. That doesn't make sense. This guy is used to selling with a Google brand on the card. Can you go hire actually a nobody who had no logo and grew the company, from 0 to $25 million in ARR? That's the sales guy that you really want to get. So yeah, I mean, we go through a series of kind of things in these couple of hours, and then we try to meet the larger management team. We look for, when the management team is presenting, we look for very soft cues. How are these founders actually in meeting, behaving with each other, right? We do want, what do you say, similar vision. Do you both see the world in the same way? And you guys can disagree, but is that disagreement in a respectful way? Is somebody just hogging the time 95% of the time and giving the other guy only 5%? So we can see that, sometimes down 6 months or a year down the line, there's going to be some resentment that's going to happen. So we try to just look for those, soft things, much earlier on. But I think the pandemic has really helped to give us more time to spend with them. And I think the entrepreneurs frankly appreciate it, because they feel this is going to be an 8 to 10 year journey with a VC. And do I want to be with this VC? So I think it's about a two-way street.
Yeah.
But here it is. We gave you off some of our secret of how we've been doing in the last 6 months.
the secret sauce. Now I'm with you. I'm a big believer in the person first, right? And you can teach certain skills and things to help grow. And, one of the things, I can't remember who I heard a VC talking about somewhere that they love, brother and sister co-founders, right? Because they can get after each other. At the end of the day, they move on in 10 minutes and they have it out, they get it on the table, they move forward, which in a roundabout way, less elegant way, is kind of what you were talking about, is how can they resolve their disagreements. And, I think that is so important. And you're right. I'm guessing most times they had the 45-minute pitch, and then you get a chance to see if they interact well in a closed, highly tense environment. But man, that 3 hours, the guard comes down. You learn probably quite a bit more about who they are as folks. So again, this is a good reminder for the audience, man. People count. You can have the best presentation in the world, but make sure you got the right team. So now I'm big believer, and I'm glad to hear that. It makes sense, right? At the end of the day, you still have to check the boxes on certain things, but put the right team together. So maybe, and again, I want to be respectful of your time, so I could probably talk to you for 2 hours, but and again, along those lines, so things you're looking for, you're solving a problem, you want the team. Is there common mistakes that you see that maybe somebody does have a good idea, other than maybe the people component, that you see too often, right? That ends up sinking a really good idea. Sounds like you can see through that in some cases, but is there some common mistakes that you would highly recommend folks to avoid as they're going through this process?
Oh boy, I mean, that that's a list. I think that's difficult,
Okay.
but the biggest, I mean, if I had to tick off some of the biggest things that we see that cause blow ups very early on, is that you and the co-founder don't really have a true chemistry, a true bond that's been there. You guys are just trying to work the kinks out, right?
Yeah.
And it means that maybe you took a sabbatical, maybe you went to the university or something and you're doing coursework and found this person and say, oh, this guy is my soulmate. Let's go start something together. I think it's really important that your co-founders are someone that you have worked with before, you have worked out your kinks, okay? And that is kind of really the key thing, because by the time you come to us for funding, we are trying to we're trying to get you ready for an A round or a B round. And we are able to take many risks. There's a technology risk, the fact that you're going to get, this ARR or not. What we don't want is you to blow up with your co-founder. Okay. So I think we've seen a lot of stuff where right before we're about to invest, something shows up and say, oh boy, this blew up. Okay.
Yeah, red flag. Okay.
Right. It might be things to do with, hey, I want more equity. And well, why did you wait so long? Like, why did you wait for a year? Or it might be like, hey, I should be the CEO, you should be the CTO. Like, come on, guys. I mean, all that stuff, you better work that out. So I think that is like the topmost point I'd make. Number two is essentially founders who maybe have a little bit too high an optimistic assessment of, you know what, I can get my Series A done even without revenue, just because the technology is so awesome. Like, no, that's your seed and seed plus round. That's not A. And you might hear stories that somebody got at a $50 million round, which is based on technology. Yes, there is a reason for it. They had done 3 other companies before. They executed like hell on those 3 companies, returned whatever 20x or 50x to their VC, and their VC is basically funding a $50 million round because it's a bet on a person that's proven. So I think if you take out those data points, then if you look at the curve, I think people at A want to look for somewhere at least between $1 million to $3 million of ARR, and that's a good point for them to do an A round in at least the B2B space.
Yeah.
So I think the makeup of the founder being overly optimistic on things like valuation, on things like fundraising, or things like, hey, this product is so awesome that I'll be able to sell it myself, without thinking through how am I going to get direct enterprise sales force, or maybe a channel partner from an incumbent, old dinosaur, but hey, you know what? It's a channel partner, or how am I going to get direct to developer marketing? I think those are really important. That's the second thing that we see is that essentially causes companies to fail. I'm happy to go on, but take me down any rabbit holes you want.
Well, let's follow up on that because I think it's interesting because one of my, I don't want to say it's a theory, but I know as different stages of growth as the company goes through it, right? As your founder-led selling, you're selling through your network, you're probably building some good relationships. You get to the $500,000, $1 million, depending on your ticket size. Now all of a sudden you go from 1 to 5 and 1 to 10. It's not a full-on operationalize of your business, but it's pretty close. And I've seen on a much smaller scale that founders who are really good, passionate about the product, they can get out and meet with folks like you and I and talk about how it's going to change the world. All of a sudden now I've got to figure out what's my marketing message and positioning, and how do I get sales and marketing aligned with it, and when do I bring customer success? It's just a whole different ball game. Are you seeing some of those first hires then to bring in some of those operational type folks that they may not have yet? Or is that, I guess, how big of a hurdle have you seen for some of these companies as they try to move from that, the early stage to, like I said, more of an operationalizing company or scaling company?
Yeah, I think that's a really good question. This stuff used to happen at Series B earlier, but we're actually starting to see that companies, right before they go up to Series A, they are starting to operationalize all of those steps. They want to make sure that maybe even if they don't have a full-time marketing hire, they might have, a person on the team who's going to get the positioning right. They may not have a VP of sales, but they might essentially get at least a salesperson who's done this, before, where the founder is starting to think about, I'm going to take the baton and then move my process. I'm going to give this blueprint of how to sell over so that I can demonstrate when I go for the A round that it's not just founder-led sales. This person also closed 1 or 2 logos. And then let me also get the work started on channels. So let me bring in a channel development person in and train that person, because when a Series A investor looks at my pipeline and says, oh well, this pipeline is not enough. Oh well, your channel, and channel is going to bring this other lift off, and it's actually the cost of sales is going to be lower because I'm not going to have to hire direct. And then they might also bring in a customer success person in, because the enterprise logos are going to require solid service, because these are your reference logos. They're going to take Series A reference calls. They're going to take your next customers that are going to come in, those reference calls. So you better have amazing customer success. So I'm saying all of this stuff, but it doesn't come for free, right? It means that you better have a couple of $1 million raised in your seed C plus rounds so that you can put these critical pieces in play, correct? If Which means now you have to be really careful with your money. You can't go and pay all of these guys $300,000 and $400,000, right? You've got to figure out, well, I might not bring a VP level or a CXO level. I'll bring in, a little bit level, but at least they should demonstrate the ability to grow. They should have a passion for not just cash compensation, but passion for, like, I'm going to take my career from X to Z. So I think that there is, all of those elements that we are seeing that entrepreneurs are basically doing for customer success, sales enablement, channel development. All of those things are happening, I think, a lot earlier than traditionally.
Yeah, it makes sense. And it's not, you don't have to over engineer, right, the Titanic in order to do it. But, the number of folks that I've talked to that, hey, I'm going to spend, 50,000 on this, Facebook ads or whatever the marketing channel is. You're going to do this, run commercials, but yet they have one person that works part-time that follows up on the leads, right? So there's not even a process to say, hey, we're making the investments. How do we make sure we're getting the ROI? Because we've got a process that goes in. And then you had mentioned customer success. I mean, it's amazing to me still the number of companies, new, old, that, it's still an afterthought. I mean, especially if you've got reoccurring revenue, that, that should be one of your first areas of emphasis is how do I protect what I have and how do I expand it? And, I think that's some of the times it's the process guy coming out in me that says, again, doesn't have to re-engineer everything, but have a plan. And I know sometimes it feels like a lot of the startups are like, we're just chasing revenue, which not discounting it all, you need it, but start to think about how you want to structure this as it goes so you can actually measure and process some of it. So yeah.
Exactly right. I mean, you don't want to go to Series A and show customer churn. Oh, well, that guy churned because we were not able to deliver what we promised, or maybe the experience was not that great. That's basically giving you a flat round if there is a churn that, or there's a continuation of go back to seed and
Right.
iterate, come back, right?
100% right. So anyway, I took my little tangent for the show, but yeah, so this has been fantastic, and maybe at some point I'd love to get you on for a part two, and maybe we can go deeper into some of the Series A execution pieces of it. But so I always end this with two last questions, and the first one is, what's next for you, and what's next for the company? Stay the course, making the investments. What are you guys focused on here, the tail end of 2020 and into next year?
Yeah, I'd say we've been pleasantly surprised by actually, we thought we're not going to do that many investments, but we've been pleasantly surprised with the incoming, both on the Japan side and the US side, in terms of the entrepreneurs that have been born in 2020, specifically in the last 7 months. So I would encourage all your listeners, I mean, if they're thinking of doing a startup, this is the best time. The reason is you can get in a couple of $1 million of seed. You can build a product for much lower cost, given a lot of the stuff that's going on with remote work, etc. And by the time you come out with your product developed in 2021 sometime, hopefully a lot of this thing is going to be at least not behind us, but at least a lot more controlled in what we're seeing from today. So I would say, the pace has been a really good, surprise for us. We are investing at a much faster clip, specifically in Japan. So what's going to be next for us is, I think we might go get focused. I'm not saying today or anytime soon, but I think we might get focused on possibly raising our Japan fund, earlier than the US one. Things might happen like that. There are in Japan, companies are going public, much faster. So I think we might do, growth vehicles out there. In the US, we are going to be focused a lot on this seed plus categories. Our investment check sizes of 2 million and 3 million, those are working out absolutely phenomenal. Entrepreneurs are really thinking through cash burn and then making sure that they get ready for Series A with at least, somewhere between $2 or $3 million of ARR.
Interesting. No, and I agree that there's no better time, right, than the prime. I think we saw in the financial crisis, 08, 09, a lot of really good companies were born out of that. And two, I think the difference, and I love your perspective, one more rabbit hole, is, as people are starting to work from home, there's always been kind of a belief that we would become more remote based. And it was just a slow and steady pace. I can't remember the percentage of companies that still had everybody in large offices. Well, now everybody's remote. Everybody's starting to really appreciate the flexibility and a true work-life balance, right? I know still a lot of companies are focused on activities versus outcomes, and that's a different conversation. But are you seeing, or you think we're going to see more, solo type companies or small groups of where we would not traditionally see companies that, I do this certain function really well. I'm going to be my own company. I'm going to work with 2 or 3 companies to do this, where it used to be design work or some of those other things that get outsourced. Are you foreseeing any bigger changes into the workforce that, again, where people wouldn't have thought about being their own company now will be? So not in a sense they're going to go raise funds, but they're working for themselves. So I'm just kind of curious if you've seen that or what your thoughts. I know you're out in front of a lot of this.
I'm on the fence on this one because somehow personally I miss that serendipity time where you'd be on a whiteboard or in the kitchen making coffee, and you've suddenly spoken to someone on your team. And I feel like, how do you solve that in a fully remote environment? I'm not fully, able to appreciate that. But I do know that a lot of our companies are building remote teams, but they're also building remote employee teams rather than outsourcing. I think, especially when it comes to key technology, owning the technology IP. I think things like payroll, things like some of the other things. Yeah, that back office kind of thing. Sometimes a controller function for a little bit while can be outsourced. But if you're going to build some very key IP, if you're going to get ready for Series A, you better have your FP&A. What kind of margins, what kind of structure you're going to build. So you better have somebody, in the team on that one. So outsourcing wise, I'm a big believer that you can use new and types of software and things like that to do your things, and those can be SaaS tools. But you can't have outsourced remote teams.
Yeah.
That doesn't somehow, the company culture and things like that doesn't flow through.
Yeah, I tend to side with you on that because I've heard the option. We can build companies that just purely based on execution and doesn't necessarily have the culture, the kind of the ebb and flow that if you're a founder and you're passionate about, and you've got people that are passionate about the mission, you're going to go through some ups and downs where that team will fight through it. Where if it was just, hey, I'm going to put the best outsources in this and we're going to go execute, go to market. We know what the problem is. I tend to lean more back to the human side of the people side is going to overcome some of these things. It's going to be fascinating to see because I know there's going to be companies that try that model and we'll see where it goes. And I would bet that they're not going to perform nearly as well as the ones that have the interaction and are tied to the mission versus,
Yeah. At stages of the company we are betting at between 0 to 5 ARR, I mean, they are going to multiple speed bumps. A competitor is going to come in. One of their co-founders is going to leave. One of their big logo customers is going to churn. I mean, at that point in time, when that is a crisis, an outsourced mercenary is not going to hang on. An outsourced mercenary, you tell them like, hey, you're going to take a 25% pay cut. We're going to give you a little bit extra stock. They're going to say bye-bye. Right. So they're not bought into the mission and the culture of the founders and the company, what they're trying to do. So I tend to agree that that's not going to work.
So maybe it's when they get to the 100 million and you're really starting to scale with a lot of different folks, you can think about it differently. But I don't know. I just think that there's too much tied to, I use my daughter as an example, 25, right? Super social, loved going into the office, loved working. Now she's been working remote for 6, 7, 8 months now. And part of it she's gotten used to. She likes having the flexibility of the no commute, but then she also misses the non-productive time, if you will, of meeting with folks. So I think that's where some of these bigger companies are going to have to figure out how to blend those two. So that's why there's so much opportunity in the B2B space beyond technology. People are going to have to figure a lot of this out, right?
Yeah. So Brett, I think I didn't even know if we addressed all the agenda items that we had said that the podcast would address. We ended up in a free-flowing, it was an absolute fun conversation, but I feel like I may have not addressed a lot of the topics that you really wanted to go after.
No, this was it. A perspective from somebody that sees the opportunity in this space, the people that they're investing in, just so they can think, because again, I think too often we get into the thing, well, I'll follow this checklist and I'll get investment and we'll go, right? It's bigger than that. And that's what I wanted to bring, somebody that's investing a lot of money, sees the opportunity to talk about it. So no, if anything, I took us off path, but those tend to be our best episodes when we get, kind of the unfiltered and perspective of folks that are living and breathing this every day. And, we don't know what's coming around the corner here. I wrote a short little post not too long ago. It was like, I've stopped questioning what's next in 2020. Let's just take it a day at a time and we'll think ahead, and, 2021 will be here and maybe there's some sort of normalcy, but I'm more of a half full than half empty. So I'm like, it's creating opportunities. How do we go just don't sit it out, find a way to participate. So again, long-winded answer to your question. You've answered, but more than and above and beyond what I thought we'd get out of this episode. So, but I can't let you go without one last question. I know our time is short, but what is one thing that you would highly recommend? And I said this could be personal, professional, something top of mind for you right now.
Yeah. So to all the entrepreneurs that are listening to this podcast, get to know your investor. Get to know. I don't care how you're going to do that in this pandemic. You figure out a way that you're going to be with them in person. Figure out a way that you're going to look in their eyes, check their expression, look into their soul. This is the person you're going to be with, having a relationship for the next 8 to 10 years. If you are just taking somebody who is giving you higher valuation, or somebody that just happens to be at a logo firm, I mean, watch out. I mean, the logo firms might have a few $1 billion funds, and a C plus or A is not necessarily meaningful for the success. They might give you high valuation to just win the term sheet, but it doesn't matter. There are good guys there too. Figure out, figure out the founder VC fit. We always talk about product market fit and the founder market fit, all of that stuff, but the founder VC fit is something that we don't look, because when you have absolute alignment on the board, when you're going, with walks, and when you're going and having off-board phone calls and text messaging with your board member, that's phenomenal. I mean, that's so much stress off your mind. You don't need to manage inside. You can charge ahead like a true entrepreneur. So try to get that on your investor side, on the board side.
No, I think that's great advice. And the first time I mean, it makes sense as you say it, but now we've had this conversation, the people side, you're right. It's a commitment. And if you don't get along, that's going to make it a really difficult time frame. So, ties back to the theme of, the people side of it, make sure that there's a fit. So I love that. All right, Q. Well, thank you very much. And in closing, if there's people that want to reach out, they have the next great idea. I'm sure you've got a process for that. But if people just want to follow you or learn more about, what's the best way for them to connect with you?
Well, we've got a little thing on the website under our contact thing, and that essentially allows you to submit your great idea. You don't have to check mark and fill out each and everything, but just send in your basics and your email. And I think at least what we'll tell you is we'll send an email. If it's not a fit, it'll be a quick no.
Okay.
But it won't be a hanging thing that just sits, on the internet.
That too many companies leave you hanging.
So yeah, our website is DNX, D N as in Nancy, X as in X-ray .vc.
We'll link to it in the show notes and all the good things so people can find it. So awesome. Well, Q, really appreciate your time. I know we took you over, so I think from my side, it was well worth it. Hopefully you get something out of this conversation as well. And, we'll look to catch up with you in the future.
Thank you, Brad.
Have a great rest of your day.
You too.